Hello everyone, good morning, good afternoon, good evening, depending upon when you are watching this video lecture. After the two important segments of allowances and retirement benefits in the chapter of salaries, let us enter into the third and also very important segment of perquisites. Of course, in addition to these three major segments of this chapter, we already discussed about the profits in lieu of salary, which included contribution by employer to the provident fund or retrenchment compensation received by the employee upon being terminated by the employer forcefully, or voluntary retirement compensation received by the employee upon choosing to be retired voluntarily according to a voluntary retirement scheme, the rules of which are framed under Rule 2BA. So after the discussion of those items, let us enter into the segment of perquisites, which is also another important segment in this chapter. So what does perquisites mean? Basically, the some extra benefit in addition to the amount that is normally paid by employer to the employee according to the contract. Of course, in general, when we say perquisites, we use the term perquisites in relation to the facilities provided, something like housing or car, etc. But there is no necessity that perquisites means always they have to be in kind. They can be in cash also, but they are not allowances. They could be usually the reimbursement of expenses incurred. They are also done in a normal office environment. But if those expenses are incurred for official discharge of duties, then there is no benefit that is arising to the employee, so that cannot be called as perquisite. So simply speaking, perquisite is a kind of benefit or amenity or a facility provided by the employer to the employee. That's what is perquisite generally to be understood as. So there are certain points to be noted. When perquisites are taxable under income from salaries head, naturally when there is a employer-employee relationship. If at all there is no employer-employee relationship, still perquisites could be taxable, but they could be taxed under the other heads of income like PGBP or income from other sources. So perquisite is a generic word that is used for those items which are enjoyed by the SASI in kind. For example, if a doctor gets a gift of a gold ring from one of his patients, that cannot be called as a normal gift. It is received in the course of profession of that doctor, so it will be also considered as his professional income. The value of that gold ring has to be included in the professional income of that doctor, but that will be taxable under the head of PGBP. But here our focus will be on the perquisites which are defined in section 17(2), related to the head of salaries only. And these perquisites can be also classified into three categories, just like allowances. First category, those which are taxable in case of all employees, those which are exempt in the case of all employees, means completely exempt perquisites, and certain perquisites are taxable only in the hands of specified employees. So naturally the word specified employee also has its own importance when we talk about the taxability of perquisites. But before going to that, what are the perquisites which are taxable in the case of all employees? Anyway, we are going to definitely go through each of them in detail. So just to look at the headings, what are the perquisites which are chargeable to tax in case of all employees? Biggest one of the biggest sections of or segments of this discussion in Prerequisites is rent-free accommodation or concessional rent accommodation. So rent-free accommodation means quarters, residential quarters that is provided by employer to the employee, wherein the employee will stay in that accommodation, but that accommodation is provided by the employer. We are not talking about house rent allowance. We need to understand that very clearly. House rent allowance means employer giving money to employee. Rent-free accommodation means employer is giving accommodation to the employee. He is not giving money, but he is giving an accommodation where the employee and his family can stay. That is rent-free accommodation. Of course, certain rent-free accommodations are not taxable, which are exceptions, like the residences provided to the judges of High Court, Supreme Court, etc., like officers of Parliament. Those things are all not taxable. Anyway, they are not taxable. There is nothing for us to much worry about them. But if the accommodation is provided completely rent-free, whatever the value of that accommodation is according to the valuation rules that we are going to discuss, that will be taxable in the hands of employee as a perquisite. But what if there is a concession in the rent? Means the employer is not giving the accommodation to employee completely free of cost. Employer is collecting some rent from the employee, but that rent is not really equivalent to the value that we valued according to the principles of valuation of perquisites. That means there is a concession in the rent. Then what will be the value of perquisite? Will it be the full rental value or the full value of the accommodation? Definitely not. Whatever the value of accommodation that we calculate, minus whatever the rent that is collected from the employee, that will be the value of concession. So that value of concession in the rent will be subjected to tax as a perquisite. So the accommodation can be completely rent-free, or even there can be a concessional rent accommodation also. That is one thing which is taxable in case of all employees, except some special people like judges, parliament officers, etc. And another important classification here, this is a very important point here. Payment by the employer in respect of any obligation of the employee. It's a very generic classification, and there can be an endless list of such things which the employer can pay on behalf of employee, whereas it was originally the obligation of employee, but now it has been met by employer. So if any such thing is happening, then whatever the payment made by employer on behalf of employee, which was originally the obligation of employee, that would be treated as perquisite, which is taxable in all cases. So what can be called as the provision here? Any amount paid by employer in respect of any obligation which otherwise would have been payable by employee. Means if employer did not pay now, employee would have paid himself. But instead of employee paying that money, employer is actually incurring that expenditure in the place of employee. So this is the very important categorization. So we can just have one common phrase for all this discussion. We can call this as obligation of employee met by employer. That is one line explanation for all this point. Obligation of employee but actually met by employer. If that is what is happening, then that is also taxable in all cases. That's what we can just summarize it. So what is the payment done by employer here? It is actually supposed to be incurred by employee, but employer is paying it on behalf of employee. Some of these things we already know. For example, if you look at the discussion we had earlier, the income tax liability of employee met by employer, and employer calling it as tax-free salary. Was that a tax-free salary? No. There is nothing called tax-free salary, but what we did, whatever the income tax liability of employee paid by employer, that also we included in the salary of the employee. Why? Because it is a perquisite. Because of this provision, that will be considered as perquisite, and that is part of the definition of perquisites under section 17.2, which means that will be taxable under the head of salaries when the obligation of the employee is met by employer. Like this list can be endless. For example, if a domestic servant is engaged by employee and employer is reimbursing the salary paid to the servant, whose obligation is to pay to the servant of employee, his employee's obligation, it is his domestic servant. But who is paying the salary of the domestic servant of employee? Employer. If so, then that means the obligation of the employee has been met by employer. That will be considered as a perquisite, and that will be taxable in the hands of all employees. So that is the point here to be noted, which is taxable in case of all employees. Then another one is also there here, which is also taxable in case of all employees, where the amount is payable by an employer directly or indirectly to affect the assurance of the life of the SSC. So life, not health. Be very clear. Simply speaking, insurance policy is there on the life of the SSC who is employee, and insurance premium related to that policy is paid by employer. So whatever that insurance premium paid by employer on behalf of employee would be taxable as perquisite. This is also, logically speaking, falling in the same category. Whose responsibility it is to have a life insurance policy on one's life? That is his own responsibility. But who is paying the insurance premium? Employer on behalf of employee. So that becomes taxable perquisite. But just to keep it clear, we are not talking about keyman insurance policy. Understand the difference? Keyman insurance policy is completely different concept. That is where employer is taking the insurance policy on the life of employee only, but not all employees, only keyman. And the final proceeds of the keyman insurance policy need not go only to the employee. There may be a portion coming to employee, there may be a portion going to employer also. Originally, the idea of taking keyman insurance policy itself is not to give any benefit to the employee. It is to give or take benefit to the employer himself. So just like a joint life policy in case of a partnership firm, when a partner dies, the joint life policy proceeds belong to whom? Not the person who died himself. It will be belonging to the firm. Similar to that, not exactly same. There those are partners. Here we are talking employer-employees. So in case of keyman insurance policy, where the life of the employee is insured by employer, telling that this employee is a very important person. Worst case scenario, if this employee dies, organization suffers a lot because this guy is a very important person in the organization. So we are calling him keyman. And anyway, the loss of life cannot be recovered. At least financially, the organization can have some benefit from the insurance policy. That is keyman insurance policy, where the final maturity amount, if the employee is alive, can be shared between employer and employee. If the employee is dead, that can be shared between employer and legal heirs of employee. So that is different. We are not talking about that. That's what we have to understand. Keyman insurance policy is not like any other normal insurance policy. That is completely a different concept. Normally, when I say insurance, life insurance, it is normal life insurance policy of the employee, benefit of which will never come to employer in future. If at all employee dies also, it goes to his family. If he doesn't die also, ultimately the maturity proceeds will go to him. So it is basically the responsibility of employee, but employer is paying life insurance premium on behalf of employee. That means whatever that life insurance premium paid by the employer shall be taxable as perquisite. Same way. And we are talking about perquisites taxable in all cases. If at all, any specified securities or sweat equity shares are allotted or transferred by the employer. Sweat equity shares are also called as ESOP, employee stock option plans. What is the specialty of them? Employer will issue shares to the employee, the employer's company's shares only, at a price which is lower than market price. For example, if Reliance Industries Limited issues shares to its own employees less than the market price of the shares, then that is a benefit given to employees. Definitely. Is that not a benefit? Definitely yes. Once it is a benefit, is it not taxable? Definitely yes, it is taxable as perquisite. How that we will see later, but we are looking at the list of the perquisites only now, which are taxable in case of all employees. One is rent-free accommodation or concessional rent accommodation. Second one is obligation of employee met by employer. Third one is the insurance premium on the life of employee paid by employer. And the fourth one is sweat equity shares or ESOP. These are what we popularly call them as employee stock option plans, ESOP that is called. So those shares allotted by employer to employee at a concessional rate. Whatever that value of concession is, that will be taxable in the hands of employee as a perquisite. And if employer contributes any amount to an approved superannuation fund, so these words are important. We have provident fund discussion already, that is completely different. We know that recognized provident fund contribution of employer is not taxable up to 12% of salary. Interest on the recognized provident fund is not taxable up to 9.5% interest rate per annum. For statutory provident fund, everything is exempt. All these things we already discussed. But now what we are talking is not that. It is an approved superannuation fund. Superannuation means retirement, we know that. Some fund, what is that? How they will do? That is all none of our business. Name is what we have to just remember. Some approved superannuation fund is there. Of course, in whose name it is there? Naturally in the name of employee. But who is giving money to that? Who is contributing money to that? Here, employer. So should it be taxable? Yes, it is taxable because employer is contributing to an approved superannuation fund on behalf of employee. In the name of employee, it will be taxable, but only after the amount that it exceeds 1,50,000 rupees. This is the amount you have to remember. In other words, we can also say up to 1,50,000 rupees, this is exempt. It is not taxable. Beyond 1,50,000 rupees only, any contribution by employer to an approved superannuation fund in the name of employee shall be taxable as perquisites only when in excess of 1,50,000. For example, if the employer contributes 2 lakhs rupees to an approved superannuation fund account of employee, 50,000 rupees only will be taxable. 1,50,000 rupees will be exempt, not taxable. That is about other taxable perquisite on in case of all employees. Then there is one more generic word, that is any other fringe benefit. Fringe benefit is any benefit or amenity or facility that is prescribed by CBDT as taxable. Of course, that will be taxable. And what are all those? We will have to go through all of them also one by one, but list is given here. One is interest-free loan or concessional loan. These are all taxable in case of all employees. How much will be taxable? We will come to that discussion later. But what is the list of the perquisites which are taxable? That is what we are looking at. Traveling, touring or accommodation, of course, for personal purposes. First point to note in perquisites is any perquisite is taxable if it is generating some personal benefit to the employee. If it is official purposes, any facility is given by the employer, that is not a perquisite because there is no benefit that employee is getting out of it personally. So we have to keep that in mind. So here, if any interest-free loan is given by employer to employee, or traveling, touring or accommodation is provided by employer to employee, or free food or concessional food and non-alcoholic beverages are provided by employer to the employee during office hours, that is taxable, of course, are subject to various limits which we will see later. Gift voucher, gifts given by employer to employee, credit card expenses, club expenses, use of mobile assets, transfer of mobile assets, each of them is what we are going to discuss. These are all perquisites only we are talking about, which we will discuss one by one. And any other benefit or amenity, any other thing. So all these facilities are taxable in all cases. All cases means all types of employees, not just specified employees. There is another category of perquisites which is taxable only in the hands of specified employees. But the first category, A category, what we talked about here, are the perquisites which are taxable in case of all employees. So this is a list of them. Of course, the details of them, we will go through them one by one. These many perquisites are there to be discussed. But that too only one category. Still there are other two categories where exempt perquisites are also there fully, and perquisites which are taxable only for specified employees is also there. Those lists will anyway will be coming. But this list what we discussed so far is only the list where the perquisites are taxable in case of all employees. That's it. Right? So that is one point to be noted here related to perquisites. Because now that the topic of superannuation funds has come, also understand whatever the lump sum amount received from a superannuation fund, what type of superannuation fund? Approved superannuation fund shall be excluded from the total income of employee at the time of retirement or at the time of whatever withdrawal we can say. So simply speaking, this is also like provident fund, like recognized provident fund, like statutory provident fund. Withdrawal from superannuation fund is exempt. So you don't need to worry too much about that. Simply the amount that is withdrawn from the approved superannuation fund is exempt. That's all. Anyway, the amount which is contributed by employer on behalf of the superannuation fund account of an employee is also exempt, but only up to 1,50,000 rupees. That is about first category of perquisites, the valuation of which we will discuss later on. Now moving on to the second category of perquisites, which are exempt from tax in all cases. So this has to be remembered. Names you have to remember definitely. What is the purpose of facility that is given, you have to remember. First one is telephone. So even though it generates a personal benefit, we have to understand that when it is exempt, it is exempt. Telephone provided by an employer to an employee even at his residence. No problem. Sir, telephone, does it include mobile phone also? Yes, sir, it will include mobile phone also. Telephone, mobile phone given by employer to employee, and telephone related expenses borne by employer on behalf of employee, all are exempt. So the monthly postpaid bill of employee, let us say, is paid by employer, that is exempt. That is not taxable. So anything related to telephone and telephone related expenses are exempt simply. Mobile also, internet also, everything along with that. No need to specially look into one by one. That is first point. Second point, transport facility for whom? Provided by an employer who is engaged in the business of carrying the passengers. For them only, it will be exempt. So if transport facility is provided by employer who is engaged in the business of carrying the passengers or goods to his employees, either free of charge or concessional rate, that will be exempt. For example, RTC employees can travel free in the buses. Like railway employees can travel free in the trains. That is a benefit received by employees. Yes. But is that taxable? No. Because it is provided by whom? Their employer. And what their employer is doing? He is in the business of carrying the passengers or goods. So such a transport facility will not be taxable. That will be exempt. That is another exempt perquisites we can say. This is an extension of that. The privilege passes or privilege tickets given by whom? Indian Railways to its employees is exempt. Fine, that is clear. And this one already we know. Perquisites allowed outside India by the government. We know that those are exempt. Under which section? Section 10(7). Already we know that. Perquisites which are given by the government of India to a citizen of India for rendering services outside India. Allowances also, perquisites also, both are exempt. Same way, if employer contributes to a staff group insurance scheme, not an individual insurance scheme. If there is a group insurance scheme of all the employees and employer contributes to that scheme, that will not be taxable in the hands of employees. Of course, it will be difficult to even segregate premium also. That's a different story. Practicalities apart, law itself says that is exempt perquisite. So these perquisites are exempt in all cases. Telephone facility, including mobile, transport facility given by an employer who is engaged in the business of transport of passenger or goods, privilege passes given by the railways to their employees, perquisites given by government of India to a citizen of India who is rendering outside India services, exempt from tax. Staff group insurance scheme, if employer contributes anything to that, exempt from tax. Then personal accident policy also, not insurance policy. Once again, you have to be clear with these names. Normally premium paid by employer on the life of the employee's life insurance policy, that will be taxable, as we have seen already. But if the employer pays a premium for personal accident policy, life insurance policy is different, accident policies are different. So accident policy premium paid by employer is exempt. And refreshments provided by employer to the employees during the working hours in the office premises, those are exempt. Once again, what is the definition of refreshment? That is difficult to note. Whatever it is, we can understand it like snacks, you can say snacks, tea, coffee, cool drinks, etc. That is refreshment. So those are exempt if they are provided during the office hours by employer to employees. Then subsidized lunch also is exempt, but there is a limit there. Up to 50 rupees per meal. 50 rupees per meal. If any subsidized lunch is provided by the employer to the employee during working hours in the office or business premises, then up to 50 rupees it is not taxable. Beyond 50 rupees it will be taxable. That means up to 50 rupees it is exempt. In other words, the value of the meal provided by employer to the employees is say 80 rupees. That means 50 rupees is exempt. 30 rupees per meal will be taxable. Multiply with the number of meals which are provided during the year, you will get the total value of taxable prerequisite in case of subsidized lunch. But let us be clear, these are practically difficult provisions to be implemented because it is not possible, not feasible, not possible, not practical also to distinguish what is lunch, what is refreshment, what is not a snack, what is a snack, and meal up to 50 rupees we are talking, not per day by the way. That is per meal it is 50 rupees. So like that employee will have 10 meals, so what? No problem, 50 rupees, like that he can have 10 meals. Still that is exempt. So there are a lot of loopholes and unnecessary things here, which the law should have just ignored them. They should have told, don't worry, all facilities provided are exempt. Like that they should have told. Unnecessarily they wanted to mess it up, telling up to 50 rupees, that too exempt. Beyond that it is taxable. Who knows how many meals are given? Who knows what is the value of that meal? All these things are practically difficult to be identified. So we don't need to worry about the practicalities. For us, in the problems, if lunch is the word used, then it will be exempt. The value of that lunch will be exempt up to 50 rupees per meal. Sir, what about if employees are working night shift and they are provided dinner other than lunch? No problem, sir. That is also part of lunch. So don't be too technical about lunch means lunch only, not a dinner. Not like that. Food we are talking, meals we are talking. Tea and snacks and tiffins are anyway exempt fully. That is already there. Next, if the recreational facilities are provided by the employer in the premises, then also those are exempt. For example, club facilities extended to all employees in general. That means they are not restricted to few employees. Everybody can use those recreational facilities. Lot of modern offices like software companies, Infosys, Google, Microsoft and all, they have sports facilities also. They have gymnasiums, they have swimming pools, basketball courts, tennis courts. Like that, they will have a lot of recreational facilities also where they can spend some time in leisure. That is a facility given by employer to employee. Is that taxable? Answer is no, it is not taxable, it is exempt. Same way, the amount spent on training of the employees is also not taxable. So if the employer spends on the training of the employee or for any course like refresher management course, including the expenses of boarding and lodging, all of that is not taxable. That is not considered as a prerequisite. That is exempt from tax. That is also point to be noted. And this one we know already. The sum payable by employer to a recognized provident fund or an approved superannuation fund for particularly these people, coal mines provident fund and all. We don't need that coal mines thing. That is exempt because they are supposed to pay whatever the amount they pay, that will be exempt. And leave travel concession is a separate discussion. We will discuss on that separately. Subject to certain conditions, it is exempt. And of course, these High Court judges, Supreme Court judges, we don't have to worry. A lot of things are exempt. No conditions for them. High Court judges, Supreme Court judges, leave travel concession is always exempt. Same way, medical facilities also, there are certain conditions, certain limits. Keeping that in mind, those are having their own exemptions. We will discuss them. For example, the rent-free accommodation, official residence of High Court judges, Supreme Court judges is exempt. Rent-free furnished residence also for officer of a parliament, union minister, or a leader of opposition in the parliament, that is also exempt. So we don't need to really worry about these things which are exempt. High Court judges, Supreme Court judges, everything is exempt. Car provided to them, accommodation provided to them, those things are all exempt. Nothing to specially worry about them. So particularly the exemptions which are important are, first things to note is the telephone facility, that is exempt, that is definitely commonly given to many people. And 10.7 we already know. Group insurance scheme premium paid by employer is exempt, that we should remember. Personal accident policy premium paid by employer is also exempt. Refreshments provided during the office hours is exempt. Lunch is also exempt, but only up to 50 rupees per meal. Recreational facilities are exempt. Training expenses incurred by employer on their employees is also exempt. Leave travel concession is altogether a separate discussion. Medical facilities is also a separate discussion, which we will discuss later. So these are the exempt perquisites, we can say one by one, related to different types of facilities given by employer to employee. Now that the topic of leave travel concession has come, let us quickly go through this section 10.5, which exempts. Naturally, when we look at section 10, we have to understand we are talking about an exemption. The leave travel concession given by employer to the employee is exempt from tax. So what are we talking about here? What is this leave travel concession? If the employer is giving any leave travel concession to employees for proceeding to any place in India, that is the first condition. So employee can travel, leave travel, that is, means not official visit. Don't think this is official visit. Official visit anyway, it is not a perquisite. But here, employee is going along with his family. Mostly the government employees, children will understand, they get this leave travel concession annually or once in 2 years, like that. So whatever it is, what they get is none of our business. How much is exempt, why it is exempt, what conditions are to be satisfied in order to claim exemption is what our focus is. So if the employee along with his family also proceeds for leave travel to any place within India, so when he is doing it, either on leave or on the retirement, after the retirement from service or after the termination of his service, this travel can take place. That is first point. Of course, this benefit is available to individuals only who can travel. Individuals only can travel. So there is no speciality in that. Definitely that will be eligible. The benefit is available for individual SCs only. The exemption is available for individuals only who can travel. Partnership firms, companies cannot travel. That is common sense. But along with whom he can travel? They can travel with the spouse also and children of the individual also. That is okay. That is normally part of the family. And parents, brothers and sisters, if they are mainly or wholly dependent on the individual. Spouse and children, there is no condition. Whether they are dependent or independent, it doesn't matter. That is the core family as per this particular section. So SSC, spouse, children, they can travel and leave travel concession can be taken and exempted. But if the travel is done by parents, brothers or sisters, then exemption is available only if the parents, brothers and sisters are wholly or mainly dependent on the individual. So that is how the word family is defined in this particular place. In many different places, the family is defined in different ways. For the purpose of 10.5, family means spouse or children, whereas parents, brothers and sisters are also part of family only if they are wholly or mainly dependent on the SSE. So spouse is once again just the word you have to understand. Spouse is the word used for both husband and wife. So it is a non-gender specific term. So spouse is a common term used. For example, if the SSE is female, spouse is husband. If SSE is male, spouse is wife. So spouse is the word used in place of wife or husband, that is, as the case may be, depending upon who the SSE is. So that is generally, once again, let us not get into same gender spouses and all. That is completely not what the Income Tax Act was ready for. So basically that's what spouse means. It doesn't have any gender. That's what you should understand. And whereas the children, of course, will be part of the family. Parents, brothers and sisters will be part of the family here for this purpose. We are not defining family who should stay with the SSA and all. No. For the purpose of exemption, what is family? That is what we are defining. That is what is family. Along with the family, the SC can travel on leave or after retirement or after the termination of his service. That's fine. And another point is here, generally the exemption is available in respect of 2 journeys performed in a block of 4 calendar years. 86 and all, you don't need to remember. It is there already long back. So, exemption, how many exemptions can be claimed? Every year can the SC claim exemption under 10.5? No, sir, not possible. Only 2. Again, are we telling that he should perform 2 journeys? No. Exemption is available for 2 journeys. He can travel yearly 10 times also. That is none of our business. Exemption is what we are talking about. Exemption is available for how many journeys? Only 2 journeys in a block of 4 years. 4 calendar years. So that is a point to be noted. However, there is one relaxation that is given. If at all, let us say, such travel concession or assistance is not availed by the SSE during any block of the 4 calendar years, then one such unavailed concession can be carried forward to the immediately succeeding block of 4 calendar years and will be eligible for exemption. How many exemptions can be carried forward to the next block? Only 1. Maximum how many you can claim? Only 2 in a block of 4 years. So let us look at an example to understand this. For example, if the employee does not avail any leave travel concession for the block of 2014-17, that was a block already fixed block. That is a block of 4 years, 14, 15, 16, 17. In that block, he did not take LTC or he did not avail the exemption of LTC. So can he avail it during 2019? He avails the leave travel concession during 2019. So the point is, he is allowed to carry forward maximum 1 such holiday to be used in the succeeding block. So what he can do? He can use the unavailed LTC of the last block in this current block, which is 18, 19, 20, 21. And he can still have 2 more exemptions also, because anyway which are there related to this block. So he will be eligible for exemption of 1 LTC which was brought forward from the previous block, and he will be eligible for exemption of 2 more journeys which can be further availed as exemption. So the point here to note is, if there is any journey that is not availed as an exemption in 1 block, if both the journeys are also not taken, we cannot carry forward both the journeys. Only one of such journeys, one of such unavailed leave travel concessions can be carried forward to the next block. These are all practical points that should be remembered, particularly when we talk about section 10.5. And what is a family? That has to be remembered. How many journeys can be taken as exemption? 2 in a block of 4 years. And if any one or both LTCs are unavailed in 1 block, they can be performed in the succeeding block. And the succeeding block will have anyway its own 2 remaining as usual. That is what the points to be noted under section 10.5. Now comes the limits, monetary limits related to LTC. How the journey can be performed. See, this section 10.5 did not give any amounts limit like 50,000, 1 lakh, 20,000. No, nothing like that it has given. But it has given the limits on the basis of the journey that is performed by different modes of transport. So on a broader basis, you should just understand and remember them. There is no numbers that have to be remembered here under section 10.5. So first of all, if the journey is performed by air, if means that is only one possibility. If the journey is performed by air, how much amount can be claimed as exemption? Amount not exceeding the air economy fare of the national carrier by the shortest route. That can be claimed as exemption. Simply speaking, economy fare, economy class ticket amount can be claimed as exemption. Sir, what if employer provided business class to employee or a first class to employee? Usually in the domestic journeys, there is no first class in the air tickets. But if at all, business class ticket is provided by employer to the employee, then what? Whatever the price that is the value of that business class ticket, minus exemption is only economy class ticket fare, remaining becomes taxable. So exemption is given only up to the amount of economy class fare if the journey is performed by air. Sir, what if the journey is performed by any other mode? Other mode means other than air. If it is performed by air, there ends the matter. Economy class fare is given as exemption. Anything excess becomes taxable. But what if the journey is performed by other mode? Other mode means we have to be clear, not necessarily the modes mentioned here, but any mode other than air. Journey can be performed by any mode. Maybe the employee can travel in car, or he can go in train, he can go in bus, he can go in ship. So many other modes are there. Then we have to look at. Then we have to see whether rail service is available for these two places where the employee has traveled. Available, that's all. Are we talking whether employee performed journey by train? No, not necessarily. Employee might have performed journey by any mode other than air. But if these two places are connected with train, let us say employee went from Hyderabad to Delhi. Yes, these two are connected by train, enough. Then what will be the exemption amount? Exemption amount will be the first class AC rail fare. That will be the amount of exemption. Whatever that is. Whatever that first class AC. Is there anything beyond that in the trains? No. Already it is clear, intention of the law is to give the best possible exemption. So, first class AC fare amount will be given as exemption if the journey is performed by any modes other than air and these two places, the origin and destination, are connected by train service. Not necessarily journey is performed by train. Understand that point. So, for example, if employee went from Hyderabad to Delhi in car and he has incurred, let us say, 20,000 rupees as an expenditure for that travel, and we are talking once again personal travel, leave travel. If the journey was performed by air conditioned first class fare, maybe the expenditure would have been only, let us say, 15,000 rupees, but actual expenditure by car was 20,000 rupees. So how much will be exemption? Only 15,000. That means remaining 5,000 becomes taxable. So the exemption amount is equivalent to the air conditioned first class fare if the journey was performed by train in the shortest route between these two places, and that is what the exemption amount is all about. Amount not exceeding the air conditioned first class rail fare. So what if the journey performed by another mode but the actual expenditure is less than the first class air fare, train fare? Then actual amount itself will be exempt. In our same example, let us say the car expenditure came to only 10,000, whereas the first class AC tickets are 15,000. Then 10,000 will be exempt completely. There we don't have to look at that. Simple logic. Exemption cannot exceed the benefit itself, always. So their exemption will be restricted to the amount of expenditure actually incurred. So that is when the journey is performed by any mode other than air and rail connectivity is there between two places. So what if the rail connectivity is not available? That means no rail service at all between these two places. Then we have to go further and check whether any recognized public transport system is there. Something like RTC is there. If it is there, then what is the exemption amount? Amount not exceeding the first class or deluxe class fare, as the case may be, on such transport system, once again, by the shortest route to the place of destination. Shortest route, why we are talking about? Say, for example, somebody travels from Hyderabad to Delhi like this. From Hyderabad, first he goes to Chennai, from there he goes to Bangalore, from there he goes to Mumbai, from there he goes to Calcutta, then he goes to Delhi. So many travels happened, but ultimately he reached Delhi from Hyderabad. So can we say that it is shortest route? Definitely not. Directly from Hyderabad to Delhi is what is shortest route. So you cannot claim all these 5 different travels as exemption. That is not correct. So shortest route means shortest route. Whatever the straight route from origin or place of starting point to the destination point. That is once again practical restriction that has been kept. But here the intention of the law you have to understand. Recognized public transport system exists. Train service is not available. Then only we are looking at it. If train is there, there ends the matter. It will stop here only. If the journey is performed by air, it will stop here only. And if the journey is performed by any modes, but train is there, train service is there, it will stop here only. If journey is performed by any modes other than air, but train service also not available, then what? Then recognized public transport system, is it there or not? We have to check. If it is there, whatever it could be, it could be a road transport or a water transport, whatever it is, a recognized public transport system. If it exists, then first class fare or deluxe class fare can be claimed as exemption. So here once again a problem comes. So buses and all, what is this deluxe class? We have deluxe buses, super luxury buses. Different names are there. Particularly Telangana and Andhra Pradesh and even Karnataka. Names are all different. Rajahamsa, like that. Some name will be there. Garuda, somebody will call. Amaravati, somebody will call. Rajdhani, they will call. Luxury, super deluxe. Whatever names they will give. So what are we talking? Are we talking deluxe bus? Are we talking like literally like the deluxe bus, which is on which it is written as deluxe? No, don't take it literally with the name. The intention of the statute is best class, top class, whatever it is. Whatever the available top class is there in that recognized transport system, that's what deluxe class means. Not going by the names of the transport systems what they project. So they will tell 100 things. They will have different names. Super deluxe they call it, semi super luxury call it, semi luxury they call it, just deluxe they call it, express they call it. What names? Those are all relevant for us. They are not relevant for us. What is the intention of the law here? We are talking about the top class. Whatever the top class available in that recognized public transport system, that much amount of ticket amount is exempt from tax under section 10(5). If when all these things are not there, if journey not performed by air and rail service is also not available, then that's what comes. Then the last worst case scenario, journey not performed by air, trains are not there, even no recognized public transport system also. Where is he going to? Jungles or not? We don't know. Maybe people can go to anywhere. No air, no train, no recognized public transport system. So what we should do? There we have to do an imaginary calculation, where if at all the journey was performed by air-conditioned first class fare for the distance of the journey. So normally in the train fares will be determined upon the distance. So per kilometer this much, like that. If the distance is 1000 kilometers, 1000 multiply with whatever fare it is. But which fare? Air-conditioned first class fare. But is there a train connectivity? No, there is no train connectivity. So it is all if and but. If there was a train connectivity, if there is a journey performed by train, and if these two places are connected by train, and if that journey is performed in AC first class, how much would have been the fare of that journey? That will be exempt. So here it is all about imaginary calculation, as if the journey had been performed by rail. But there is no rail. If there is rail, we don't have all these problems. If there is bus also, if there is a recognized public transport system also, we don't have this problem. There is no air journey, there is no train connectivity, there is no recognized public transport system. Only option left to us is imagination. If the journey was performed by train, how much would have been the distance between these two places? Multiply with air-conditioned first class rail fare for that distance. Then whatever you get, that's what is called as exemption in the last case, where no recognized public transport system exists. That is one point here to be noted. And there is one more restriction here. The exemption here shall not be available to more than 2 surviving children of the individual. Means up to a maximum of 2 children only this exemption is available, starting from 1998. Again, you don't need to remember that date. But what is important here is, that is a crucial point in the exams also it is asked, is what about multiple births? That is a practical issue. For example, multiple births means twins we are talking about. Twins, triplets, etc. So, for example, first there is one child, and afterwards there were twins who are born. Then can we consider them as 3 children and stop exemption for one of them? That is unfair. So what we'll do? We'll consider that multiple births as 1 birth only. That will be considered as if it is 1 birth only. So that is okay, eligible for exemption in such case. Another scenario. Imagine first twins, already two kids are there for the SSC. Then another 1 child has been born. Then also will the exemption be available for all the 3? Then no, because already quota for 2 is over. So maximum exemption can be claimed for only 2 children, only exception being if multiple births happened after the first child, then the multiple births after the first child will be taken as one child only. So that is about one of the exceptions to this 2 children related scenario. And whenever we say children, that point has always to be remembered. Children include stepchildren and adopted children also. So that is section 10.5 exemption for leave travel concession provisions. In the exams, these were asked also many times as a part of a bigger question or separately a small MCQ. Anyway, is also possible. So look at this illustration. Mr. D went on a holiday during our previous year, naturally, to Delhi with his wife and 3 children. This is something to be where we have to be attracted. 3 normally is not allowed. But look at the details. One son age 5 years and twin daughters age 2 years. So is that okay? Absolutely okay. Why? Because the twin children, the multiple children were born after the first son. So that both twin daughters will be considered as if it is one only. That means the restriction we will not impose on them. That is the point. Considered as one means they will not become one. They are 2 people, 2 human beings. But the restriction of only 2 children will not be applicable in this case. All the 3 will be eligible for exemption. That's what is the essence we have to draw. And they went by flight, very good. That too by economy class, okay, that is fine, no problem. And the total cost of the tickets reimbursed by the employer was 60,000 rupees and 45,000 rupees for the adults, 15,000 rupees for the 3 minor children. So for the adults means himself and his wife, 45,000 rupees. For all the 3 minor small kids put together, it was 15,000 rupees. Total 60,000 rupees. His employer has paid the cost of tickets by economy class. What is wrong with that? Nothing wrong with that. Absolutely. Entire amount will be exempt from tax under section 10.5. So why is that? Since the son's age is more than the twin daughters, Mr. D can avail the exemption for all the 3 children. So the restriction of the 2 children is not applicable in the case of multiple births after 1 child. And all the other conditions satisfied. Holiday is being in India because it has happened to the destination of Delhi. Delhi is in India. And journey was also performed by air, that to economy class only. So all the things are matching, no problem. So entire 60,000 is exempt. Nothing will be taxable in this case. That is illustration 10. Illustration 11 is a continuation of this. So what if in the above illustration, will there be any difference if among the 3 children, the twins were 5 years old and son is 3 years old? Then what? Then there will be gafla. There is a problem. Why? Because first twin daughters have been born. That means 2 children quota is already over. Then another son is born. So that son unfortunately will not be eligible for this exemption. One of these journeys should not be exempted. Okay. So out of this 15,000, which is for 3 people, one is not exempt, means how much will be taxable? 15,000 divided by 3. That is 5,000 rupees becomes taxable. So how much is the taxable leave travel concession? In that case is 5,000. How much is exempt? 55,000. Spouse is okay anyway. 45,000 is absolutely anyway. SC himself and spouse both are exempt. 2 daughters also in this case exempt. Only one son who is born after the twin daughters, towards his travel concession or leave travel concession, whatever the employer has paid, that is not exempt, that is taxable. So 5,000 rupees becomes taxable, and exempt LTC is only 55,000 rupees. Okay, that is about one of the important aspects related to leave travel concession. That is one type of prerequisite which is exempt under section 10.5. But only point why we are discussing all this if it is exempt, because there are conditions. Conditions are what? The journey should be performed within India. We are not talking about employer giving reimbursement of leave travel of employee going to Singapore, Hong Kong and all. No, that is not exempt. Only the journey should be performed within India. If it is performed by air, then economy fare only will be exempt. If not, first class railway fare or the first class deluxe fare of any type of journey will be exempt. And most importantly, this exemption is available only for up to 2 children. That's all. And who is family in this case? That is also an important aspect. Spouse, children are anyway part of the family. SSC himself, spouse, children. that too 2 children. But if there are parents also, brothers and sisters also, who are wholly or mainly dependent on the SSC, they can also be considered as part of the family, and their travel expenditure also can be exempt, depending upon whether they are wholly or mainly dependent on the SSC or not. So that is a point to be noted related to leave travel concession. Now, moving on to another prerequisite, this is also a separate type of discussion, that is medical facilities. Medical facilities looks like exempt, yes, but medical allowance is always taxable. Remember that. It was there as a fully taxable allowance in all cases. That is medical allowance. So always be clear about whether we're talking about allowance or a prerequisite. If let us say the question says leave travel allowance, people will not read fully. No, leave travel means exempt, they will tell under 10.5. No, sir. 10.5 is not about leave travel allowance. It is leave travel concession. If at all another word is used, it can be called as leave travel assistance. Leave travel concession, leave travel assistance. These two are okay, but not leave travel allowance. Leave travel allowance is fully taxable. All these things will not apply to that. Same way, medical allowance is fully taxable. Fully. These all exemptions will not apply to that. But here, if medical facilities are provided, then there are certain conditions under which that will not be treated as a prerequisite. In other words, such prerequisite or facility provided by employer will be exempt from tax. It is not taxable, we can say. When it will not be treated as a prerequisite, medical facility given by employer to employee, when the treatment is provided in any hospital maintained by the employer. In that case, whatever the amount of expenditure that employer might have incurred on the medical treatment of employee, entire value of that medical treatment is not taxable. It is not considered as a prerequisite at all. When is that? If the treatment happened in any hospital maintained by the employer. A lot of big private corporate companies have their own hospitals, and particularly the employers like railway and military, they have their own hospitals anyway. Army hospitals, railway hospitals, we see them. Municipal hospitals will be there for municipal employees, like that. If at all, whichever the hospital it is, if it is maintained by employer and treatment is done in the hospital maintained by the employer, then such value will not be taxable. Imagine, just for understanding purposes, let us say one of the employees of Apollo had a problem and he has been provided medical treatment in Apollo itself. Then that amount is not taxable as a prerequisite. That is not considered as a prerequisite because medical treatment is provided in the hospital maintained by his employer himself. So that is not taxable. First point. Second point, if at all the employer does not have any hospital, but he is reimbursing the expenditure, the medical expenditure actually incurred on medical treatment. So employee has undergone treatment in some other hospital, but employer is paying that money to employee. He is reimbursing that medical expenditure, we can say. Then what? Then also it will not be considered as a prerequisite if that hospital is maintained by government. In other words, government hospital, if at all employee joins and the expenditure of the employee related to the medical treatment in the government hospital, if it is reimbursed by employer, that is not a taxable prerequisite. So here government includes local authority also, or for that matter any other hospital also approved by the government. So if any approved hospitals are there by the government, or what are those approved hospitals? I want a list of that. That will be with the CBDT. We don't need to worry about that. That is not our area of interest. Our area of interest here should be if the hospital is approved by the government, or if the hospital itself is a government hospital or a local authority hospital, and employee gets a treatment there and employer reimburses the medical expenses of that treatment, then it is not a taxable prerequisite. That is not taxable at all. Also, if the medical treatment is in respect of specified prescribed diseases or any particular ailments in some hospitals which are approved by the Principal Chief Commissioner or Chief Commissioner of Income Tax. Once again, what are those diseases? Is corona covered in that? That is none of our business. There are some diseases, we don't need the list of them. There are some ailments and there are some hospitals, we don't need the list of them. But prescribed diseases, approved hospitals, that's what we need. So for the prescribed diseases, if the treatment is done by the employee or undertaken by the employee or his family, by the way, in the approved hospitals for the prescribed diseases, then also there is no taxability of such perquisite. So if the treatment happens within the hospital maintained by employer also, treatment happens in the government hospital also, treatment happens in any approved hospital for specified diseases also, there is no value of perquisite. Okay, so that is a point to be noted for exempt perquisite in respect of medical facilities given by employer to employee. Only then. So what if employer reimburses the medical treatment of employee in a private hospital? It is not in the exemption list, right? That means it would be taxable. There should not be any question there. Only exemption is given when these conditions are satisfied. If these conditions are not satisfied, means automatically that is taxable. As simple as that. That does not require a special provision. So what is exempt explicitly, that only is exempt. If it is not exempt explicitly, it is implicitly taxable. Automatically it is taxable. So that is a point to be noted. These are not taxable perquisites in respect of medical facilities. But another very important aspect, this also will be there in the questions. Premium paid to effect the insurance on the health of the employee. Earlier we have seen two types of insurance policies. I would like to remind you. One is group insurance on the life of employees, all employees grouped together, that is not taxable. Same way, accidental benefit policy also not taxable. By the way, not taxable perquisites are equally important as taxable perquisites. So don't think anyway these are not taxable, that's okay, I can just ignore them. No. In the exam questions, there will be 10, 15 different lists given. In that, some of them will be taxable, some of them there will be computations, some of them there will not be computation. For not doing computation, for writing nil there, and for writing a note saying that those are exempt perquisites, those are not taxable perquisites, you get marks. So for not doing also, you will get marks. You cannot say, anyway, we are not going to do anything now, what is there to know about it? These are important exempt perquisites, which are not taxable. For example, group insurance policy taken on the lives of the employees, but premium paid by employer, such premium is not taxable in the hands of employees. Accident policy premium paid by employer, not taxable in the hands of employees. Also, health insurance policy taken by employer on the health of employees, any premium paid by employer is not taxable in the hands of employee. And not only on the health of employee, for the family of the employee also, the amount of health insurance premium that is paid by employer or even reimbursement of such premium by employer to employee, both ways, it is not taxable. So wherever you look at health insurance, which can also be called as medical insurance, the premium paid by employer or reimbursed by employer is not taxable. That is completely not a perquisite at all. Okay, so that is about medical treatment within India. What are not taxable? Those are the medical treatments within India related provisions. Now let us see one more point here. What if the amount is paid towards expenditure incurred outside India on medical treatment? So employee himself or maybe one of the family members of the employee is going abroad for what? For medical treatment. And who is paying the expenditure? Naturally employer. Then only we are discussing this. If employee pays his own money for his own expenditure, what is there to discuss? But employer is incurring expenditure on behalf of employee for the purpose of medical treatment of the employee or his family, then how the exemption will be or how the taxability will be is a separate discussion once again. But what are the things that can be there as a part of this expenditure? What is this expenditure we are talking about actually incurred by the employee? That could be on the basis of medical treatment of the employee, definitely the real hospital fees, and travel and stay also. That is also part, right? When you are going abroad, you have to have flight tickets and there you have to stay, and stay expenses will be there also. That is also another expenses. And not only that, travel and stay abroad for one attendant also, because the patient himself cannot go all the times. So patient requires one attendant. So the expenditure is not taxable if expenditure is incurred by employer towards the expenditure related to medical treatment of the employee or any member of family of the employee, or travel and stay abroad related to the patient, travel and stay abroad related to the one such attendant, one only, not more than one. Entire family goes for abroad trip and one of them is having a medical treatment. No, not all the others are exempt. One patient, one attendant, exempt. Yes. Expenditure should be related to what? Medical treatment or travel and stay of one patient and one attendant. So medical treatment is not for attendant naturally, that will be for patient only. So that expenditure is also exempt if the employer pays towards the medical treatment of the employee or any member of the family outside India. However, conditions apply. It is not just like that. What is the conditions here? First of all, the expenditure that should be incurred abroad, that should be permitted by RBI. Reserve Bank of India, how much ever amount it permits, that much only is given as exemption in relation to the expenditure on two things. One is medical treatment, first one, and second one is stay. Still one thing is remaining. What is that? Travel. That is a separate condition. For medical treatment and stay, how much can be exempted? To the extent permitted by RBI. If the RBI permits, then whatever the permitted amount of RBI is there, that will be exempt completely in the hands of employee. Understand what is happening here? Employee himself or any member of the family of the employee is going abroad for medical treatment, and if the RBI permits such a amount to be spent outside India for the medical treatment or stay, to such extent the entire amount of expenditure incurred by employer on behalf of employee would be exempt from tax. Condition, the amount should be permitted by RBI. But second one is again a little nasty condition, but we can't help it. That is a law. In respect of traveling, exemption is given, of course, related to whom? Patient also, and we know one attendant also. Yes. But condition is what? The employee's gross total income should not exceed 2 lakhs rupees. So gross total income, not even income from salaries. Gross total income, all heads put together without deductions, it should not exceed 2 lakhs rupees. Means those people who have a gross total income of more than 2 lakhs rupees, if they traveled abroad for medical treatment and employer has paid their air tickets, that becomes taxable. That becomes taxable. There is no exemption for those people whose gross total income is more than 2 lakhs. But by the way, certain points to be noted. Sir, is the employee himself patient? Not necessary. Patient could be employee also, any member of family also. Another point. Sir, should this attendant also be part of the family? He should also be member of the family? No, not necessary. Attendant could be anybody. Somebody can be just taken as attendant, anybody. So these are practical issues. Patient need not be employee. Employee need not travel, not necessary. He himself need not be attendant also. But his family member may be patient, or attendant could be somebody who is not even a member of family also. But for medical treatment and stay, there is no problem as long as the amount is permitted by RBI, they will be fully exempt. However, for travel expenditure here, it will be exempt only if the employee's gross total income, not the patient's gross total income. This is where simple points they will try to confuse. Not the patient's gross total income. We don't worry about patient here. We worry about employee. Employee's gross total income does not exceed 2 lakhs rupees. If so, then only that travel expenditure of the patient and one attendant is exempt. Otherwise, it is taxable. And condition says if it does not exceed 2 lakhs, then only it will be exempt. Automatically, that also means if the gross total income of the employee exceeds 2 lakhs, automatically the travel expenditure reimbursed by employer towards patient and one attendant will become taxable. That's an important aspect related to medical treatment. So what is this family here? Family is simple, straightforward here, no big thing. Here directly spouse and children of the individual. See, children need not be dependent. Maybe dependent, independent, married, unmarried, doesn't matter. Spouse, children, are always part of the family. But what about others? We know that parents, brothers, sisters, only when if they are wholly or mainly dependent on the SSC, then only it is family. Same definition what has been given for LTC. There is nothing new about family. Here also LTC also the definition of family is same, and patient could be anybody within this definition of family, not neighbors, not friends, not cousins, not grandparents. Look at that. These are where twist points will come in questions. Parents, brothers and sisters. That's all. Of the employee. Employee. Individual means the employee who is claiming exemption. So that is family for the purpose of medical exemption also, medical prerequisite exemption also, and leave travel concession exemption also. These two are one of some of the important prerequisites where the exemption is applicable, and there is one illustration here that can be just looked at by looking at each of the items one by one. Illustration 12. Compute the taxable value of prerequisite in respect of medical facilities received by Mr. G from his employer during the previous year 1920. So one by one let us see that. Medical premium paid for ensuring the health of Mr. G. I am highlighting means it is exempt. If I am not highlighting, it is taxable. So it is exempt or not? Medical insurance premium. Absolutely yes, because G himself is the SC and he is the employee. For his health insurance premium, employer paid, that is exempt from tax. Treatment of Mr. G by his family doctor. Family doctor is not exempt. It is not there in the exemption list, so it will be taxable. Treatment of Mrs. G in a government hospital. Government hospital exempt, so no problem. That is not taxable. Treatment of Mr. G's grandfather in a private clinic. Grandfather is not part of family, so not exempt, fully taxable. That too in a private clinic, anyway not exempt. And treatment of Mr. G's mother, who is aged 68 years and dependent on the SSC, by family doctor. Once again, family doctor always taxable, nothing exempt. Treatment of Mr. G's sister, dependent in a nursing home. Dependent sister, nursing home, taxable. G's brother, dependent or independent, 6,000, anyway taxable. But who is paying all this? We have to understand. Who paid all this? Employer paid this. For exemption, the dependent or independent matters. Anyway, if it is taxable, how does it matter whether it is dependent or independent? All these things are taxable, taxable, taxable. Now comes the treatment of Mr. G's father, who is a dependent on the SSC, so definitely is part of the family abroad. 50,000 rupees is the medical treatment expenses. Expenses of staying abroad of the patient and maybe one attendant also, 30,000. But the limit specified by RBI is only 75,000. So naturally what happens here? 80,000 is the treatment and stay expenses. 75,000 only is exempt. So 80,000 will not be exempt. Only 75,000 will be exempt, which means 5,000 becomes taxable. So if you compute all these things put together, what all will be taxable, one by one, we can have them. So first, 5,000 rupees is definitely going to be there. That is taxable. This is related to the 80,000 minus 75,000. That is 5,000 rupees related to medical treatment abroad. That is taxable. And going earlier things, this 5,000 rupees is taxable or not? Yes, it is. This 12,000 rupees is taxable or not? Yes, it is. Definitely, it is also taxable. Then we have 8,000, 3,000 and 6,000. So look at them. 8,000, 3,000 and 6,000. Whatever the sequence may be, ultimately those are all taxable. So what is the total value of all these things coming to? 39,000 rupees. That is a taxable value of prerequisite. So irrespective of whether they are family or not, once the treatment is happening in a nursing home, family doctor, employer is paying, exemption itself is not applicable. Even if they are family also, exemption is not applicable. If they are not family also, exemption is not applicable. So all of them are taxable here directly. So 5 plus 12, 17 plus 8, 25 plus 3, 28 plus 6, 28 plus 6, 34 and 5,000, 39,000 total is the taxable amount of prerequisite in this case. That's all. That is about medical prerequisite. And this one we already know, the personal accident insurance policies premium, what about that? That is also exempt from tax. That is not at all taxable. That we already know that. So these are some of the exempt perquisites that we discussed. But exemption is not automatic, by the way. It is subject to certain conditions. What is important for us to note is what are those conditions in the particular case or problem. Are those conditions satisfied or not? Those have to be very keenly observed. Then only we'll get the correct answer. So these are few perquisites which are exempt, and the list of perquisites which are taxable in the hands of all employees, we have already discussed that. The list we discussed. Valuation we are yet to discuss, and in the next session we'll discuss about the perquisites which are taxable in the hands of specified employees only, and most importantly the valuation of those perquisites, how to do that. We will continue this discussion in the next session. Till then, take care. Bye bye. Thank you very much.